Mike, what are we learning?
Well, this is the latest iteration of a long effort to try to align U.S. bank regulations with the rest of the world. It's generally sort of known as the Basel III proposals. In essence, they simplify the rules, the calculations for capital retention, account for risks differently, and have different standards in some cases for smaller banks. For the biggest banks on Wall Street, Category 1 and Category 2, they've been required to use two risk models in the past to calculate the risks of their activities, a standardized one and their own internal risk model. Now they're just going to have one single set of risk-based capital ratios. The expanded risk-based proposal would include standardized risk weighting methodologies for credit, equity, and operational risks. It would also introduce an explicit operational risk requirement calculated based on a firm's income and expenses. It would also include a standardized methodology for calculating risk-weighted assets for market risk. And then something that folks on Wall Street are really concerned about, the global systemically important banks, the G-SIBs, would be assigned surcharges in increments of 10 basis points rather than 50 basis points, and the risk models would be simplified. According to McKee, the vice chair for supervision at the Fed, she says this will not make the banking system any less resilient. Together, she says these changes would strengthen our overall capital framework, which would remain robust under the new regime. Banks would maintain their capacity to absorb losses while continuing to provide financial services to households and businesses across a wide range of economic conditions. And certainly there are benefits to the banks, guys. The calculation, according to the Federal Reserve press release, is that Category 1 and 2 banks would see their capital requirements go down by a net 4.8%. Category 3 and 4, down, the regional banks basically, down 5.2%, and for smaller banks, 7.8%. There's been a big concern, especially among smaller banks, that the specific risk measurement models used for banks did not really apply to them because they don't do all the banking activities as the big banks, so they're getting the biggest break out of all of this.
I'm looking at the KBW banking index, and it doesn't seem to be moving very much. Right now, we're down by about 2/3, but that was the case before this announcement. 2/3 of 1%. That was down before this announcement as well. How telegraphed, how ready were financial markets?
They were ready for this. This has been going on for quite some time. Last week, McKee Bowman gave a speech and sort of outlined the general contours of what they're going to do. But you remember, we had a proposal, and then when Michael Barr became vice chair for supervision, he withdrew that, put out another one. Everybody hated that. He withdrew that when after he first proposed it, said they would do it again, and then he resigned as vice chair. McKee Bowman came in, picked up the baton, and now this is her contribution. This obviously goes out for comment before these rules take effect, but it does seem that enough people have signed off on this that this is probably the regulations that the banks are going to get, and it basically incorporates most of what they wanted.